Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Earlier this week, 3 of the big 4 banks surprisingly dropped their term deposit rates. Here this morning to talk about that is Nick Chaplin from Seed Funds Management. Welcome, Nick.
Thank you, Chris. Appreciate the time.
So what was your take on this? Well, first of all, was it a surprise?
I think it was a surprise to many people because it's a bit of a gauge on what the banks think the direction of rates is. So all of them coming off, some of those rate levels, as we heard in the media or read in the media, were quite large, up to 80 basis points. And when term deposit rates are sort of bumping up against 5%, that's a lot. And we've seen CBA and come down about 50 points, NAB down about 50 points, ANZ up to 80 points, but really the average was quite a bit lower than that. It tells you a little bit more about the direction or what the bank thinks the direction of rates is in the future than anything else. But it was a surprise, the size of the move, yes.
At the same time, you've got the Reserve Bank actually saying that they're considering or considered raising rates. And at the last Reserve Bank meeting, it was quite a tight decision as to whether they'd keep them on hold or raise them. I don't think anyone was expecting them to drop them. But the banks have moved anyway.
They have, and it probably tells you a little bit more about what they think the state of the economy is in the short term, medium term, because as they fund their balance sheets with wholesale money or money coming from the cash that comes in through term deposits, so they like to have the retail money basically funding their balance sheets, they may not need as much. So it might be a little bit of a view on their growth rate and the bank's growth rates, which have been fairly steady recently if we've gone through the recent reports. They've been pretty good. However, this may be a signal to the future that they may be expecting harder times with growth, don't need the money as much, and so they're just dropping that term deposit. It is a lever on, and it's a fairly useful one and very sensitive one to whether the retail money comes into them or not. Interestingly, many banks dropped their term deposit rates at the same time. It wasn't just the big 4, it was multiple.
So it's across the board. We'll leave the question of collusion to another day. But what does it do for you as a fund manager where you're offering 7 or what's your current 12-month?
Well, the last 12 months was 8.4.
So 8.4% makes that pretty attractive, does it not?
It does. Investors need to think about, obviously, the moving from a fairly risk-free cash environment to, in my case, prudential capital instruments of the banks and senior bonds, still fixed income. And I think most people that have made the move from cash to this fund are generally thinking they're comfortable with the survival level of the banks in Australia and the insurance companies in Australia. So they're happy to move cash in because they're comfortable that the banks aren't going to fail. But certainly, if we use that last 12 months, and of course it's no guide to the future, but still it's, getting on for double the return you can receive in cash, particularly after this term deposit drop. So it becomes an attraction for those managing fixed income to their funds. And hopefully they can manage those funds to the same level in the next 12 months for people.
Sure. So you're not suggesting that people move holus bolus out of bank term deposits. Your story is really, let's have a slice of the pie and diversify across these.
That's it. I think, as we've recently seen some equity volatility. We saw the Japanese equity market hyper drive down 14%, then back up 10%. We saw that sort of mirrored in the US market for a little while there. It was really less than a week that occurred, but it still caused quite a move to cash out of Australian equities, out of Australian hybrids, and then it's very difficult for those people to get reset, particularly at their levels. They've just taken a capital gain tax hit as well by doing this, and so it's very difficult for them to get reset at those levels. But they need to be thinking about a piece of that pie, and I think with interest rates historically not that high, actually, if you think about it, over 25 years, but over 10 years, they're a lot higher than they historically have been. So increasing that pie in fixed income, but keeping some cash there for that rainy day is important, and that's how I think people are thinking.
Dick, can we just turn looking forward a little bit? We've got CPI numbers out next week. There's a bit of a tussle going on between the Reserve Bank and the government about what's the cause of inflation. The government, of course, is trying to say that they had nothing to do with it at all, and they're helping it go down, that is, but it's not going down. What do you see coming up in that regard?
I see CPI, I think, more or less staying around that level of 3.94%. I don't see a major drop happening. If it does happen, it would be temporary. You would see it rebound either in the next monthly CPI or the next quarterly CPI. We haven't got control of it yet, and I think the RBA governor knows that. As we've talked about before, there can be sometimes some political pressure one way or the other that they don't like rates going up. However, she needs to manage this very, very carefully and separately completely from the government. So it's a tough ask because I think if CPI is still hovering around 4%, rates aren't high enough. But, putting rates up is difficult there is distinctly a two-speed economy in Australia. There are people that actually don't mind rates going up because they get a better return on their fixed income deposits, despite TDs going down. Rates going down too early means we haven't conquered inflation. It could get worse, and the government has contributed to inflation with the spending capacity that's gone on, and perhaps not enough fiscal activity or reduction in fiscal spending that we should have seen over the last 2 years. However, the broader trend in CPI is down. And of course, Michelle Bullock can't stay sitting on her hands either, because with 4% inflation, the real return for everyone is reducing, sitting at 4.35 cash rate. I would perhaps, if I could put a subjective view in, Chris, suggest that she should maybe, being a little bit maybe OCD for me, is push it up to 4.5, just go up 15 and see what that can do. But rates are not high enough at the moment to conquer inflation at the same level we're seeing it maybe moving in the US. And we should probably see 2 or 3 US rate drops before we even move.
Well, if you saw a rise here, there'd certainly be screams from Canberra.
There would be, but they need to keep their hands out, nose in, much like the director of a company.
On that note, we'll leave it where it is. Nick Chaplin, many thanks indeed for your time.
Thank you, Chris.
Thank you.